So to finance this the cash cycle, we need to do short-term financing. There's two different types of the short-term financial planning. So one is the flexible, the other is the restrictive. So flexible policy has a large amount of cash and marketable securities. The marketable securities are very short-term assets. Large amount of inventory, so large current assets, right? It's all current asset field. Liberal credit policy, which means that you basically just the give the credit easily. So it's a large account receivable, obviously, relatively low level of the short-term liability. So you decrease the short-term liability so that you keep the very high liquidity. This is kind of the called the flexible policy. And there's another policy called the restricted policy. Now the cash level low, marketable securities also low, and inventory is low. So this is low current asset and little no credit sales. So you basically also reduce the needs of the short-term financing and relatively high short-term liability. So helps eventually getting low liquidity. For flexible, the advantage is it's not easy. It's not difficult to meet the short-term obligation because you have a lot of cashes and current assets. Cash available for emergency because you have high level of cash, and you can lower storage costs because you increase the inventory level too. But there's disadvantages to the liquid securities is lower return, so that you can lose some opportunity to get a higher return to investing in long-term projects. Financing short-term asset with long-term that is quite risky, right? Because if it doesn't match each other, and you basically just have to pay pretty high interest rate, and it's a long-term debt, and you just buy short-term asset. That's risky. That's actually a risky policy. Restrictive financial planning policy also have the advantages, pros and cons. Now the pros, now higher return on long-term assets, lower carrying costs because the inventory level is low, and the short-term liability can be decreased more easily in case of economic downturn. So in economic downturn, you basically have lower short-term liabilities, so easier to decrease. Now, disadvantage is the less liquidity for emergency because you don't have cash, you don't have current asset. That's a problem, and higher storage costs because that's the problem of having a low level of the inventory, right? So there's a different cost called the carrying cost and shortage cost. Actually, this is not storage cost. This is shortage cost. Yeah, that's what I think. I'm sorry. This is a mistake. So higher shortage cost because of lower inventory. So what is the carrying cost? Carrying cost is the opportunity cost of owning current asset versus long-term asset that pays higher returns. Cost of storing large amount of inventory, that's all carrying cost. Shortage cost is now because it's short of the inventory, it's basically you have to order additional inventory or transfer in cash. That's the cost that's called order cost. And stock out cost is cost of lost sales due to the lack of inventory, because you don't have inventory you cannot sell, or including lost customers. That's called the stock out cost. So if you have high inventory, then you have carrying cost. If you have low inventory, then you have shortage cost. There's two different types of the current asset. One is the permanent, the other is temporarily. Now, the permanent current asset is the level of current asset that companies should retain regardless of any seasonality in sales. So they have to keep these current assets to be liquid. And now you can change the temporary current assets. Now there's additional current asset that when sales are expected to increase on seasonal base, so you can increase the current asset level. So in bad time, you have to keep still the permanent current asset level. In good time, you can also have the additional temporary current asset level. So this is alternate to the financing policy. Now, because we have seasonality, the policy F always implies the short-term cash surplus and large investment in cash and marketable securities. So you always have these margins, this is the kinds of the asset, additional asset, temporarily current asset, right? So this is the level you require. You always keep just the maximum one. So you have some certain current asset left, and this is temporarily one. Now this policy R, now you can actually have, this is you need. Now you have certain asset you need to finance. Now you have long-term financing this much, and you only financing short-term here. So you have long-term financing plus short-term financing. This one just a long-term financing, and include the short-term asset. There's two different types of the asset financing policies. So how to choose the best policy? You have to consider the cash reserve, the maturity hedging, and relative interest rate. There's no decisive one, good one, but you can actually have like kinds of the pick one of them, or actually you can also compromising like this. So this is compromising one, this is seasonality. Then you can actually just compromise certain. You can still keep a certain level of the long-term asset, including the marketable securities, and then you finance short-term asset here. This and short-term financing, right? This is short-term financing. So we can compromise two of them. Cash budget. So cash is very important because the short-term financing planning, you basically need to work on cash. So it identifies the short-term needs and opportunity, and also identifies when short-term financing may be required. And how it works, first of all, we have to identify cash sales and cash collections. Now you identify the various cash outflow and subtract outflow from inflow and determine investing and financing needs. So we basically have to budget this, do this job to require like to get to know the required short-term financing needs. So this is the example. The expected sales by quarter is the 200 million, 300 million, 250 million, 400 million. Now we have beginning account receivable to 120 million, and collection should, this is like the statistical model may be calculated, the beginning receivables plus half of the sales, that will be collection. And accounting payable should be 60% of sales. Wage, taxes and expenses 20% of sales, and interest dividend 20 million per quarter, and major expansion planning per quarter to costing 100 million. So there's large expenditures in second quarter, $100 million, and beginning cash balance is 20 million with minimum cash balance of 10 million, which means that you need to have minimum 10 million cash balance all the time. Now let's look at this spreadsheet. Now in quarter one we have beginning 120 receivables, which is the receivables calculated by here, right? 120. And then we made 200 sales, and we collect the beginning receivable, which is 120, right? Plus half of sales, 200. So $220 million will be collected. So ending receivables should be, now we have negative 20 cash more, right? So decrease by $20 million. So $100 ending receivable. Then will be beginning receivable in quarter two. We made 300 sales. So collect cash again. Last year sales, receivable. I'm sorry, receivable plus 100 plus half of 300. So 250, right? And then this case $50 receivable increase because sales 300, cash collected by 50, so 150. Same way, then we have cash collection cycle, the schedule here. Now the second part is the cash disbursement. Now the payments of the account will be the 60% of sales, so we calculate it in each quarter. And the wage, tax, expense is, I believe, 20% of the sales, still calculated in each quarter. And then we have big capital expenditure in second quarter, and this is long-term financing expenses, 20 million per quarter, interest and dividends. And calculate total cash disbursement is 180, 360, 220, and 340. Now we can calculate the net cash flows using the total cash collection and total cash reimbursement. So first quarter we have 220 cash collected, but we also dispersed the 180, so 40 cash flow inflow, right? Second quarter 110 outflow, third quarter 55 inflow, fourth quarter 15 outflow. So beginning cash balance is 20 million we have, right? Now net cash balance 40 million, so we have $60 million ending cash balance. And then, as you know, we have to have the 10 million cash all the time. 50 million surplus. Now you have 60 million. Now we have to disperse like more. So 110 million net cash balance negative. So ending cash balance 50 million. Now we have 10 million again minimum cash balance. So we have to finance actually $60 million here, right? Again 50 million. 55 million from the net cash balance. Ending cash balance should be 5. And we also have to keep the 10 million, so we need to finance $5 million cash. Again, 5 million first beginning, and then 50 million outflow, ending cash balance negative 10 million. Again, we need to have $10 million cash all the time, so 20 million short-term financing is needed. So this is the cumulative surplus and deficit we have. Now, how to borrow? So there's a number of different borrowings, in short term. This is unsecured loan. Unsecured loan is a loan without security, without collaterals. And first one is line of credit. This is very common in bank. So it's a pre-arranged agreement with a bank that allows the firm to borrow a certain amount on a short-term basis. So it's a negative balance of the checking account. May require cleanup periods, Committed loan is the formal legal agreements that may require a commitment fee and generally has a floating interest rate. So that's another short-term loans from the bank and called the committed loans, and have the floating interest rate. Now another unsecured loans called the non-committed loans. Now this is agreement is not legal. It's informal agreement with the bank, and it's very similar to the credit card. Now, the revolving credit is a non-committed agreement with a longer time between evaluations. It's called a revolving credit. It's also very similar to the revolving credit card agreements for the individuals. There's also the secured loan, and there's a security. So, if you use the account receivable as a security, because the account receivable is the money that we usually collect, then you can also use the account receivable financing. So lender has some account receivable as a security, but borrower is still responsible for collections. It's called assigning receivable. So you're not really selling the receivable. You basically have to collect. You can also, there's a factoring receivable. Now account receivable discounted and then just sold to the factors. So if instead of just collecting receivable, you can actually just sell these receivables to factor, and the factor will collect it. So this is kind of the, you sell the receivables, the bad debt sold to the collection agents, and collection agents may be factored. That's another way to finance using the account receivables. You can also use inventory loans. Blanket inventory lien, which means the lender has lien against all inventory. So the borrower use the inventory as a security, like as collateral. Trust receipt is the borrower holds specific inventory in trust for the lender. So not all inventory, just a specific inventory full of trust interest, and it's it's very common for automobile dealers. Field warehouse financing is called the public warehouse act as a control agent to supervise inventory for lenders, so that you have to get secured, right? So the lender want to get some security, not just the security of the loan itself, but also security of the security itself, right? So public warehouse act as a control agent to supervise this inventory for lenders. So this is how to finance, So now we beginning cash balance again 20 million and 40 million. So we really no need for short-term financing, but from the second year we need to finance it, right? So 110 million. Now you basically have to increase short-term borrowings. So short-term borrowing $60 million, so that you still have the 10 million cash balance all the time. if you have some borrowings, So short-term borrowing, ending short-term borrowing is 60 million. Now third quarter, still you have 10 million, right? And net cash flow 55 million. Now we have to pay interest. If the 20% interest rate is charged, then you pay interest for the short-term loan, and the short-term borrowing repayment is $52. So you basically have to borrow 8 million, and then you have negative $50 million net cash flow. So you need to actually pay interest for $400,000 for the $8 million short-term loans. You still keep $10 million as a ending cash balance, and you have to borrow $23.4 million eventually. So that's the amount of short-term borrowings. And this is the end of the chapter 17. Please practice it using the spreadsheet attached on the slide. Thank you.